Hey, good morning, good afternoon, good evening, wherever you happen to be. We've got all kinds of people rolling in from around the world. It's a great day, 25th of January, Thursday. So tomorrow is the monthly expiry. It's pretty big. I don't think it's the biggest ever, but it's pretty big. So we got lots going on. The market's quite quiet today, though. So let's just wait here for a couple minutes as more people roll in. We'll take care of a couple of housekeeping items here. And I think other than that, waiting for a few people. I've got some trades going on right now. I got the charts ready to go. Now, the funny thing with the charts today is that I've been trading so bloody much the last few days is I just can't keep up with all the positions I have. It's, because I basically flattened the book as we went into this Bitcoin ETF news, or not flattened it completely, but almost. So I had lots of available risk I could do. And it felt so good. It felt liberating again. It's like, I'm free. But you know what? 5 days later, boom, you're back in the thick of it. I've got more things expiring tomorrow. I got pages of things expiring tomorrow. But anyways, I'll give the highlights of that. All good. Back to the old managing the options book, which is really the best way for us to make money, unless you're extremely patient, which I'm not. All right. So I think we got everyone in. Great to have everyone with us. It's fantastic. It's a beautiful sunny day here in Andorra. It's actually quite warm. It's actually too warm. The snow's melting, which isn't a good thing if you want to ski. So
yeah, I was skiing yesterday on the here, and the snow was a bit like pasta, but it was a nice day. At least you can ski for a couple of hours and then go and sit in the sun, have a beer and a steak.
Yeah. And then you get the artificial snow on top, which is kind of like sugar, and then it's like,
Yeah.
Anyways. All right, so let's dive into the agenda today. Just before we start, hey, good to see everyone. Thank you for the hellos. Andre, Giandrea, Volodymyr, Kor, Dom. Great to see everyone as usual. If you have any questions, please put them in the Q&A section of the chat, and we will answer questions at the end of the seminar, which is, or the little broadcast, which is about 30 minutes. Yes, Dom, it's Thursday already. I know, right? Okay. What are we doing today?
Actually, and I see we've got a couple of employees from Deribit, so they're clearly very keen to understand how they can make 17,000% a year return.
Now, I got to apologize to our regular audience because I'm usually a pretty straight shooting guy, but I did take some liberties. It's not untrue. It's not untrue, and I will explain everything in a minute. But it is a little bit clickbaity. Okay, I will admit. But I also had a little bit of fun with that headline. So I hope that everybody's going to enjoy what we're talking about today. But as always, we review the current market. What we think's going on, what we're doing generally macro, and then we get into some micro stuff, some current trades and strategies we've got going on. And then, of course, the topic is 17,000. That's right, 17,000% annualized Bitcoin option returns Richard is generating. So quick, where can we pile into your fund, Richard? I'm just kidding. We're not soliciting anything.
Give me about a month and there'll be a fund.
Okay. All right. Okay. And before we get started, too, of course, we're the Rogue Traders. I'm Shane, my partner, Richard. Hey, we've got roguetrader.academy. Check us out. We've been doing this since the 90s. I've been trading options a long time. It's just the way it goes. So we've got, if you join us, with our silver members and higher, we've got interactive live trade alerts, post our discretionary trades there. You can chat with us during the day. Got a weekly Ask Me Anything call, access to great educational content. We're trying to make it really unique, interesting stuff. And then we do daily live streams, too, on Patreon and hopefully OnlyFans coming soon. So check that out. Also, if you are not a Deribit member, if you do not have a Deribit account, in the chat, you'll see a post-it at the top, save 10% on Deribit fees. Use that link, do us a solid if you don't have a Deribit account, but I'm sure everyone here already does. Anyways, let's head over to, where are we going to go to? Let's go to the charts. Let me turn my screen share. Where's my windows? Here we are. And today I actually have an Ethereum trade. I haven't put in an Ethereum trade since November. But the other day I just couldn't resist earlier this week when the market was kind of pressed down Bitcoin was pressing down 39,000, 38,000, that area. I did put on an ETH, and I shorted yes, it was a naked short, 2,100, and I'm out of 2/3 of it already. It's only got 1/3 left and expires tomorrow morning. So that's good. But let's go over to Bitcoin and we'll see what we got going on. Now, I did something different today. I just put in a bunch of stuff. I can't put everything in because it would look like spaghetti thrown across the screen. And I took all the lines out because it got very, very confusing. So basically, I'm not doing anything right now except strangles and spreads. Short. Okay, so what I did is on that dip down here, I took advantage, and sorry, this red thing was from one of our students. I was showing him something. I said, well, I don't think we're going to penetrate into here. If we do penetrate in this pig zone, we're going to go all the way down to the bottom, and I'll just adjust things. Fine, okay. So I do have 26th, 27th, and 28th of January, 36 to 39,000 put spreads. That means I'm short 36 to 39,000, and it means I've got long underneath it. So I'm long all kinds of stuff down here, all kinds of stuff in case of a catastrophic bottom falling out. But those are my short prices for the put spreads. February 2nd, which is next Friday, a week away, I do have very similar things, 36 to 38,000 put spreads. And then I do have a Feb 9, 34,000 short put, which is part of a short strangle. Now, when this thing was coming down, it's down hard, I started scaling in. It's not like it came down to the bottom and, it's the bottom. And, I don't know, it's the bottom, right? So what I did make a couple of adjustments. I might have had some 39,000s that I moved to 38s. I might have had some 38.5s and I moved to 37.5s. Maybe I did a 1x2. I bought back one, I sold two further down. Sometimes I split them, I strangled them out, whatever I did. I just adjusted the risk around to where I was comfortable. Didn't have to do too much because, as you can see, we didn't get much below 38,500, and then we popped right back up. On the upside, 26th of Jan, I got some 41,500 call spreads. That's the short strike price. That's a bit tight. We could be there in a heartbeat. I'm fine with that. I mean, well, that's tomorrow, so who cares? It's done. Feb 2nd, which is next Friday, 43,000. Again, we could be there pretty quick, but I don't mind adjusting calls so much. I don't like adjusting puts as much. Puts are a bit more painful. I always make sure I have extra coverage. And I will mention that on most of these dates on the put side, I'm not covered 1-to-1 on the puts. I'm covered 1x2s. I've got double long on most cases, sometimes triple or quadruple, depending. Because when the market moves up, I'm in there buying those cheap puts. I'm in there buying them 12% down, 8% down, whatever. I'm buying them up for next to nothing. If they expire worthlessly and I don't get a chance to sell anything against them, oh well, no big deal. And that's how I keep these rolling. And I always have cheap cover in place, or almost always have cheap cover in place because of that. So anyways, what else have I got? I got the Feb 2, got 43,000, 44,000 short calls. On the upside, on the call side, I don't have as much coverage. I'm long the underlying, right? Don't need it. If the value of Bitcoin goes up, my account's going to go up because I got that. I just have to manage the short calls. These are basically covered calls. And we do have some coverage on some of those strikes, but not all of them. Or some of those expires, but not all of them. And you can see here, I've got the 09 Feb, same as the 34,000 put. The other side of that is the 43,000 call. That is pretty tight, but I wanted to earn some premium, and I'll look to close that out. If we just go sideways here for the next, 5 days or something, or deep into next week, I'll probably just close that out. But that's what I got going on in Bitcoin. And boy, I got to admit, there's been some good trading. And maybe it's just because it aligns with the style Richard and I typically employ. But the equity just keeps going up and up and up and up. You get the odd day when like on Monday, Tuesday when we dip down and your equity temporarily goes down. But if that market recovers and we can move that risk around, boy, it's been great. If every month could be like this month, I don't know. I'd just be sitting on a deserted island somewhere and sipping cocktails or something. Anyways, Richard, is there anything you want to say about the markets or trading or what you got going on for strategies for Bitcoin or Ethereum?
Yeah, so I've been pretty much doing the same old thing. My strategy is largely, if vols are unexciting, I will sell enough sufficient iron condors with a bit of bias depending on where the vol is, but to try and pull in about 50 basis points a day, 50 basis points of NAV per day. That's kind of my baseline position, and I think 50 basis points of NAV per day, if I consult my magic spreadsheet, so not, this is 50 this point is 0.5% is oops, that generates 600% a year in return if you compound it. So I'm just sort of gradually adjusting my positions to be pulling in about 50 basis points of theta per day. Now, obviously, you never really realize all of your theta because you're buying back positions, you're having to roll and move and pay fees and all the rest of it. But if you're working on the basis that in the bad times you're picking up 6x per year, the reason I choose that number is that these iron condors, of course, are covered. So I am Vega limited. They tend to be short dated, so I've got less Vega risk anyway, and they're limited risk, so the margin engine is not complaining too much. And often, if you pick the strikes right, you can actually. And if there's anyone from Deribit listening, sorry about this, but you can actually game the margin engine to get risk on without the margin engine thinking you're in much risk, because you can sort of sell, like, let's say, 30 delta call, go buy a 10 delta call or 6 delta call, maybe buy 2 or 3 of the cover and sell 1 of the risk, still pick up good theta. But the margin engine is saying, well, a 20% move up is going to actually make you loads of money when actually you're running risk. So you actually get quite low margin use doing that. And then what I'm waiting for is for the vols to blow out. Now they'll blow out with a move. So when it moves against me, it's going to move more than $1,000 or $2,000 over the course of a couple of days. So some of those really short-dated positions are getting the money, which I'm going to have to manage them, and I'll manage them by either just continually rolling them at the same strike, or I'll manage them by rolling them out to maybe a week or 2 weeks or something, and doing a calendar diagonal to pull in enough premium. But that when I do that roll, I'm rolling into higher vol because the vols will have gone up as a result of the move and the general panic in the market, whether it's up or down. And I'm buying back super short dated Vega and I'm selling longer dated Vega, which means that I'm getting more bang for buck. So it means that those positions, even though I get an initial loss in PV, I'm actually building up loads of intrinsic value and loads of theta, which is all going to come back to me. And all I've got to do then is keep those positions out of the money. And then the strategy of, in order to keep those positions out of the money, rather than hedging the futures too much, because I tend to find that I don't like the implied cost to carry in the futures on Deribit so much these days, unless I'm short them. So I will then do things like, as you suggested, rolling maybe short 1 Bitcoin to short 2 Bitcoins notional, maybe $1,000 or $2,000 higher in strike for same total premium, keeping the cover in place, and so building up the risk. So I'm now consuming a bit of margin, but I'm actually using the margin engine as a buffer. So I'm receiving the market movement into my book, putting a bit more risk on as the vol increases. And as long as you're gentle when you do that, and you can roll into a 1x2 or a 1x3 if it's been a big vol move, or if a 1x2 or 1x3 isn't going to absorb the move, then you can actually say, I'll roll it with a 1x2 diagonal, so I can buy back one of the 40 delta and then sell 2 of the 1 week further, I don't know, 20 deltas or whatever they are. And buy myself that time, and of course I'm also long the underlying. So if it's on the call side, it's all well and good. And I'm finding that's working really well. So my return in November was plus 30%. My return in December was plus 7.5%. I think month to date in January, I think I'm plus 12%. And that's living with no stress. Margin use never above 45. I think one day it went to 50. Because I mismanaged some cover, and it's all pretty good. We saw we saw a 20% drop from 48,000 down to 40,000 ish. I think I took a I think a 4% PV hit on one day of it, then that reduced to 3%, then 2%, and then actually now I'm back at all-time highs, even though the market hasn't recovered. And that took 2 weeks to recover all-time high, actually to beat all-time highs. And we're now back into printing money, but we're printing money when vols are low, so I'm just going to keep the pace off. On a $50,000 account, I'm very happy to just take $250 a day, which is going to get me my 5x if the markets stay boring. But when the markets get up to sort of 60, 70 baseline vol, or even 55, that gives me enough confidence to go and I can go and sell, say, 20 delta strangles, and if the baseline vol's 50, I'm going to be selling those strangles at 70 or 65, 70, and I will sell 60 vol all day long, because we might get a spike up to 80, 90, 100, extreme move, but it's going to be super temporary, and any cover I've got is going to more than help me save me through the margin squeeze. And I know that the market can't stay at 100 vol for very long, because 100 vol is like an order of magnitude bigger prices than 60 vol, right? So there's just no way that anyone can just keep on buying vol at those numbers. The vol buyers will go bankrupt within a week, and so and then when there are no buyers, there are only sellers, right? So the vol comes down.
And I just sorry, Richard, I just had the D-vol up, Derbit's D-vol, and it's at like 46.5 or something right now. So it's hanging out near the lows it's been since since November, really.
Yeah. Yes, and then so just to clarify, so when I think our outrageous number of 17,000% was from one of I gave you a risk report, didn't I?
You did, and we both had a chuckle on it because you were out of town, and we both had a chuckle. And while you're finding that, I've got a funny story about that. I remember I was prop trading, and I was big trading floor with dozens of other guys, and we had a new guy, and he'd been there for a couple of months maybe, and he was very hit and miss. He was breaking the rules too often in terms of letting things go against him too much. And one day, he made like $5,000 or something in a day or something, and he was running around the office, going to the manager saying, "I'm on track to make 50,000 this month." Based on this one day, right? So we had a lot of good chuckle and sat him down. I said, "Okay, well, every day's not going to be like today." So that's what I thought with yours, and I had a good laugh because, of course, it's not sustainable, but it made for good clickbait, and it was, a nice return and nice.
Yeah, well, I mean, I was thinking back to when I first started trading, when I didn't understand what risk management was, and you can get away with an awful lot if you're completely ignorant. This was back in 2003, and I turned. I'm sure I've told you the story before. I turned $50,000 into $1 million. Pounds, sorry, £50,000 into £1 million in 18 months, and I took about a £600,000 salary out of it while doing it. So it can be done, but only in certain sort of market conditions. What I'm going to do is just share my little spreadsheet illustrator thingy. Screen share. Am I going to confuse it with screen shares? I've just repurposed my. So can you see that?
Yep, I can see it. Can everyone? If you can't see it, just post it in the chat. You can't see it, but I can see it. So
I'm sure if everyone, I'm sure if you can see it, everyone can see it. So here, this is like the theta rate we're returning, and if so start with a 0.5% of your book's net asset value, and this of course this assumes that you're going to reinvest your returns every day, and you're going to compound up your risk. But if you're making 0.5% a day over 365 days, then if you compound that up, that's 617% per day. The day in question where we were looking at my risk report, I think I was using about 30% margin, and my theta was showing 1.42% of NAV, of NAV, and with zero delta, and it was all just like a perfect book with margin was happy. There was loads of cover in place, and there's a technique.
It was like
that
the eye of the hurricane.
Yeah,
you're in the eye of the.
And I said, look, I'm making my theta's 1.42% of NAV. I'm using almost no margin. I've got nothing at risk in the book, and so if you compound that up, that's 17,000% a year.
Yeah,
but that's and that's actually, I have done this before, so and I have achieved those kinds of returns before. So I know it's perfectly possible, but by no means automatic and by no means easy. You need to sit and accept the measly 600% until the market moves in favor, and you need to be ready for it. And one of the ways you stay ready for it is that you have cover in place, so that when the vol blows out, you have enough margin to go and sell enough risk to take advantage of that vol blowing out. Because if that vol blows out to say 70% at the money, the first thing Deribit's going to do is try and kill the party by making all of the margin requirements more stringent, like they did just before Christmas. They went from 15% shock to 20% shock, and worse, went from 40% vol shock to 60% vol shock, which stops you from writing any long-rated risk full stop. And so that makes it much harder to get risk on in those times when the market's moving hard, which is exactly when you want to get risk on, right? And so you've got to be ready for it, which means you've got to have your long cover in place before that happens. And the way you get your long cover in place is that when you're selling your iron condor, you're always looking for opportunities to buy two lots of the long leg for every one lot of the short leg that you sold. Right? And whenever you get an opportunity to pick up some cheap shrapnel in the wings, you do it. And you certainly never trade uncovered. You definitely want to spend anything longer than 2 weeks out. Up to 2 weeks out, you're spending at least a quarter of your short option premium on buying long premium, and beyond that, with Bitcoin, because of the curvature of the what's it called, the smile, you're probably actually spending a third or even 40% of the premium that you receive, and it feels like a terrible waste. But I can assure you that if you've sold, say, 20 delta with 10 delta cover in a 1x2, and you've jiggled it about so that you've bought that cover super cheap, then if vols compress and you get your risk back, and then vols blow out again and your cover's still in place, suddenly you've got the opportunity to sell twice as much risk at twice as much vol, and therefore 3 times or 4 times as much premium. And so you're setting yourself up to win. So all of that wasted money that you're paying in insurance, now and again, not one time in 10, or on FTSE it's 1 month in 9, but in crypto it's like 1 month in 3. It pays big time, because then you're then pulling in, I don't know, 3% or 4% of NAV per day in theta for during that time, and so you can make up what you weren't earning before. So, in summary, to earn 17,000%, you're going to have to work pretty hard. But to make like 1,000% a year, I don't think it's that difficult. I think the Bitcoin market's all right for that, without too much stress. I know it sounds like a outrageous claim, but the trick about it is actually just being careful to make sure that you're always one step ahead of the market, always buying cover when it's cheap. And certainly don't panic, don't chase the market. A lot less delta hedging than I might have done systematically, and judicious rolling of positions to take advantage of the vol moves. You always want to use them, whatever the market's trying to do to you. You want to try and reverse it and do it back to the market. So those vol spikes are great, because you can. Yeah, but when we're here at what now, 45 vol at the money, the last thing I'm going to be doing is selling like 3-month vol, because if we do get a move, even though I'm not going to be in the money, the Vega will have caused me 100% loss on all my positions.
Yeah, there's a lot to learn if you're fairly new to options. And in fact, I mean, we manage a lot of different accounts, and not every account has the same strategy underlying. So what I share with my charts is just one kind of little side account where I'm trading a little bit more positionally so that it's easier. Because it'd be hard for us to sit there and explain how we manage the book because it's fluid. It's fluid and it's always changing. But this morning we were talking about, well, this is low vol. It could go lower, but maybe it's time to put on some 1x2s. We don't like to pay for anything. So if we think vol is going to expand, of course, you want to be long calls or puts, but let's sell two for every one we buy and have them in such a position where we're comfortable having to roll that. We've always got the long underlying. The same is true. We're buying double cover, and I think I talked about that when I had my charts up. I buy short dated cheap cover all the time because I never know when it's going to come in handy. And longer dated too. If it looks like a great value, sure. But I think you're dead on there, Richard. When you say that you generally have to be prepared if you're going to do that style of trading. Now, if you don't want to do it, you just want to wait for opportunities. You wait for the market to drop 10% and then jump in. There's nothing wrong with that. I love that style of trading. Okay, fine. You got to sit there and be patient and wait. But if you want to earn that data every day, like we're talking about trying to earn 600% a year, 1,000% or whatever, you've always got to be collecting premium. There's times when you back it off. There's times when you turn it up, and you just got to roll with that market. But if you've got that extra coverage in place, you're golden.
I was going to say because if you're looking for opportunity, so let's say you're waiting for like a 5% sell off in the price. Well, in Bitcoin, it's never 5%, is it? It's either 1% or 20%. So you get a 20% sell off, and so you go piling in, selling put spreads, or maybe even buying riskies, something like this. That's fine because you're doing it with a flat book, so you're using whatever margin that Deribit has given you to get as much risk on as you can. But it's actually you can actually double that if you're there ahead of the market and you were buying those super short cheap wings cover. You were covering your put spreads, buying back your risk, and then leaving your cover in place. So you're leaving all this shrapnel lying around. Then if you do get that 20% down move, you've got loads of choices because that shrapnel suddenly becomes worth a lot of money. So you can just buy it back. You can sell it straight away, just get rid of it. Or you could think, you know what, screw this, I'll just sell 3 times as much. Let's work it. And so you find that you have way more margin to play with. So you can really maximize on the opportunity.
Yeah, and this is the kind of stuff we talk about all the time with our members. So if you want to go deeper into this conversation, of course, feel free to join us and over at roguetrader.academy. So we had a few questions here. Vladimir, a 5-minute speech on everyone can print money trading options. Yes, that's true. But of course, there's always the caveat. We've been doing this for a long time, and trust me, we've taken our lumps.
Yeah.
Trust me. A lot of pain, a lot of tears.
The biggest loss I took in one day was £500,000, and that was because I was actually I was greedy. I was actually selling vol too cheap, too much of it. I was fighting to stay on to pay for my millionaire lifestyle when the markets just weren't prepared to give me the money, and so I was trying to force it, right? And so I was trading this 600,000 account, selling 100 lots of FTSE. It's like immense amounts of risk, like 6 million notional risk, aside, and doing that in three consecutive months, just desperately trying to maintain the income. And if the realized vol in the market's 14 and the implied's 12, you ain't going to get the money out, right? You're just going to sit there and nursing losses all the time, and you don't want to be nursing losses when it's big. So what I should have done was sold one of my Maseratis, cancelled one of my holidays, and sold some children, of course, and just reduced my lifestyle. I think back then it was costing me 30 grand a month just to exist, just to pay all the shit I bought, right? And so I was just chasing yield all the time, and you never want to be in that position when you're trading. You want to live on a nice 2,000 euros a month, pay your mortgage off, pay 1,000 euros a month on food or dollars, whatever it is, walk in the mountains, don't go to stupid nightclubs, and then live frugally, and then you don't need huge income, and then you can take advantage of the market when it wants to give you the money, right?
Was that a dad talk or what? That was
listen, son.
At that time. What do we got? What if we got young guys on here who want to drive Lambos and gals, or I mean, come on, different strokes.
Come and see me for a special session if you want to buy a Lambo, and I will give you a good hard slapping for being such a good fool.
One thing I did want to mention when we're talking about, let's say you put on a spread, a short spread, and you close out the short side or profit, and you're quite happy. Richard's talking about leaving that long side intact. I mean, maybe you close it out right away, don't leave it intact, but you're taking a nice profit out. Or you're buying short dated cover. You're buying this cheap, like the price is moving up. So you're buying cheap puts, and you can go a month or two. You can go a long time buying this cheap stuff that doesn't cost much, but you never really get a chance to utilize it. And people can get frustrated and stop and say, "Oh, this isn't worth it." Well, you know what? It is. It's just like insurance, and it's nice to have, because when the market does blow up in Bitcoin, again, every few months it's going to move, 10% or so. It's nice to have, because that we call it shrapnel. Those little bits left out in the wings can become worth a lot just intrinsically. Plus, it can be worth a lot to sell more options against, and again, keep your margin low and allow you to sleep at night. Not selling naked. So, very, very important.
Listen, I once had dinner with my broker because I got to the stage where I was doing so much business that I was invited to dinner by my broker. And that's a warning sign, by the way, because we sat down and worked out how much money I'd made and how much money I'd spent on this cover that I'd never used. And it galled me, because it came to something like £300,000 across the year that I'd spent on cover that had never been in the money. Right? And I said to him, "Look, I don't want to buy this cover anymore. It's ridiculous. I could be £300,000 better off." And he said to me, "Look, you made £1 million this year. Well done." He said, "I'm your broker. I made £1 million off you too. The 300,000 isn't your worry, right?" And I was paying him £6 a lot. It was the fee I was paying, and he earned a bit of the cross as well when he farmed it out to the dealer brokers. And he got a bit of keep you alive. He got a small rebate from the prime broker, and he had made as much money as I had made, and I'd done all the work. But the point is that the majority of my spend was on fees, not on cover. And crypto is no different, right? Don't sweat the small stuff. If you're spending a third of your profit on cover, happy days. It's like just paying tax to the man, right? Yeah.
It'll stop you from blowing up your account, because capital preservation is the name of the game.
Yeah.
Dom says, we've done this, paid the mortgage off, got a simple life, now we're much richer than anyone we know. Nice.
Yeah, that's the way.
Nice. I like to hear that. Yeah, good stuff.
Debt is a cancer. Even debt on property, all debt's cancer.
Yeah, debt is. You want to avoid it. Prince, yes, quarter of premium collected for cover, quarter, third. Yeah, it depends. If you're doing short dated, it might be less. But I think Richard was kind of talking a bit more specifically about longer dated. But that's a good rule of thumb. Just expect to pay it. If you pay less, great.
Often, if you're selling like 2 or 3 day strangles, you can get away with spending 10% of your premium on the cover.
Yep. In which
case you'll definitely buy double cover, right?
And that's what I was just going to say. It might end up getting closer to 15% or 20%, but you'll have double or triple. And if things blow up, you'll be just really enjoying that. All right, we've got a few questions here. We've got a little bit over time. Vladimir, which position should I take at periods of low Bitcoin IV? For example, 30 to 40 vol. If I think the vol will spike, but don't want to buy options, but want to sell them. Well, I'll just quickly say, hey, in this case, if you think the market IV is going to expand, then you can always buy. That's the thing; it's going to go up. You can buy options, but you can sell 2 against it to pay for it, or sell 2 against it, or sell 1.5 against it, or something to pay for most of it. Like, you don't have to, pony up full thing out of your pocket. Richard, what's your thoughts,
sir? There's that. There's all kinds of stuff you can do there. Also. We've done the maths. We've done the back tests. We know that if you're gonna dumbly sell covered calls, we absolutely know that you should sell 1 week 40 deltas, because that actually has a positive payoff even if you never hedge it, and you just sell those 40 deltas at 1 week and let it expire. Covered calls, you'll make 10% a year, and not a lot, and it's volatile, but what that's telling you is that sweet spot of 40 deltas 1 week, they are basically overpriced, or historically have been overpriced. So not a bad place to start. Now, it's not comfortable being short calls at 40 delta, but if you're along the underlying and you're prepared to roll out, you will keep your underlying as long as you're disciplined, particularly if you bought cover. So 40 delta, 30 delta, 1 week, 3 days, it's fine, right? If you're short the perps and therefore delta neutral, and you're holding synthetic cash, then you could consider doing the say 25 delta strangles in 3 days. You're certainly going to have to manage one side of it, unless you're mega lucky. But that management isn't going to be too painful, and you could be a couple of $1,000 in the money, and you could roll out 1 week, 2 weeks, and then suddenly you're free. You're free and clear and out of the money again. So you can pick up money while the weather's calm. When the weather goes bad, you're bad for 3 days. You're recovering over a week. Meanwhile, you're selling new risk, picking up all that vol, and then you're free of it all in 2 weeks, 3 weeks. You're back to where you were on that one that went wrong, but you've pulled in loads of premium on the ones that went right.
Another thing we really love too is diagonals too, and a lot of people say, "Hey, I think that long term this is going to happen, but I don't know if it's going to happen in 2 weeks or 4 months." They might want to buy some longer dated stuff and just sell those shorter dated against it until you pay for it.
Yeah, for sure.
Because as Richard said, they're a little bit easier to manage. You might get put under pressure for a few days, but they're easy to roll. If I sell something that expires in 2 or 3 days, I can roll it to the end of next week. If that doesn't work, I can roll it another week out. You don't have to push it a month and then 60 days down the road, which a lot of people get caught in those monthlies. And then you're sitting there with things expiring 4 months from now. I don't know, the world could end in 4 months. I don't know. Like that's a long time in the crypto option world.
The trick here is not to be proud, right? So if you've sold your 40 delta call and then the market moves against you, which it can pretty quickly, particularly if it's a 3-day option, you'll want to roll it quite quickly and get out of there. So if you're wrong, you're wrong, right? You just roll it out to a week or 2 weeks. Get rid of it, because you don't want to be fighting from being underwater if you can help it, because that just consumes margin and for no real gain. It's not something to be frightened of, but you have to realize that once you're there, you're in management mode. You're not in money making mode, right? And you want to try.
It's a lot easier it's a lot easier to roll it when it's out of the money or at the money versus in the money.
So normal markets,
not dealing with the intrinsic.
Normal markets, I'll sell like 20. I'll actually open with 20 deltas, maybe 1 week out or 2 weeks out. And if they get to 40 delta, and it looks as if they're going to stay there, I'll actually roll them then, because I don't want to wait for because you can get a lot more value if you're rolling a 1x2 or 1x3. You do a lot better if you're rolling a 40 delta to a 20 or a 15 than if you're rolling a 50 delta to a 20 or
Yeah, fantastic. Question from Stan: when you decide to roll out the position of a sold options, do you do that like only when price hits your strike, or other methodology? Also, do you use stop loss orders like buyback if option price goes 2x credit received?
Shane, sorry, yeah. You
well, I was going to say, yeah. If it starts getting at the money, I'll start rolling. Unless I think it's just a wick down, I might wait a little bit. So, for example, when I showed you the chart, that dip down that Bitcoin did on, I guess, Monday, went down to 38.5 or something. I had some 39.5, some 39s, some 38.5s. I had all those strikes short. I did move some of them. Some of them I let go a little bit against me because I felt it was just a bit overdone. I could have been, the market could have just we could have been at 36. I don't know. But it's experienced. And I just decided not to. But I think it's a good policy to roll it before you get into trouble, because it's just a lot easier to roll it when there's no intrinsic value in there.
I totally agree. I used to have the rule that I would sell 30 deltas and then roll them on the second touch of being at the money. So it would get in the money and then come down again and then be in the money again, and then roll it to say, okay, enough's enough. These days, I'm even more conservative. I'll start at 20 delta and roll it on second touch of 40 delta. because I just and if the market's looking strong, like it was, through November, I won't even just wait. I'll just roll that 40 delta to a $20 strangle and get rid of it, because you're better off trading the vol differential than you are trying to be clever and timing the market. It's just an easier life and you make more money.
Question from Andre. Good story from Richard. We'll rewatch later, trying to understand. From my understanding, which new position would Richard take right now? Well, Richard doesn't really take positions. He just trades a fluid option book usually. But if you've got something you want to share, go ahead.
What would I open with right now? I would be really wary of opening right now. I think we're in an interesting time. You've got to be aware of your surroundings, right? So we've had this run up to 48K in the anticipation that the ETF thing is going to save Bitcoin, and we're all now worshipping at the footstool of Wall Street, which I find hugely ironic and laughable. But the surprise curveball was that FTX receivers, the receivers for FTX disaster, were offloading their GTBC or Gitcoin, what's it called? Grayscale Bitcoin Trust. Had to convert it to an ETF so they could liquidate, and so there was as much liquidation going on of Bitcoin as there was buying by Fidelity and BlackRock, etc. And that sort of wrong-footed everybody, and everyone thought we were going to the moon, but actually we dumped 20% and then flatlined as those inflows matched the outflows, and now no one knows what to do. So what's the next thing that's going to happen? I suspect the next thing that's going to happen is that BlackRock, Fidelity, etc., are going to go on a massive advertising campaign to get people to buy their ETFs. And I happen to know that one of those firms have pre-bought advertising over the Super Bowl, which is a big deal in the US. And they, I think they're in a game where they feel they have. It's almost like a game theory game where do you not play or do you cooperate, or sorry, do you bet or do you not bet? Do you go into ETFs or not for Bitcoin? The trouble is, any firm that, if the ETFs are popular, then any firm that didn't do a Bitcoin ETF is going to have people leave them because they're going to turn up at BlackRock and Fidelity and say, I want to be in a Bitcoin ETF. And then while they're there, the Fidelity or BlackRock sales representative is going to say, well, while you're here, you may as well move all your investments to us. And I think this is the play for the likes of BlackRock. I don't think they think in a life month of Sundays that Bitcoin's going to go to $1 million a Bitcoin. I think they think that this is the new hot thing and they've got to be in it, because if they're not, somebody else will be in it and their customers will be speaking to other firms. So there's going to be a lot of competition to get people to put money into these funds, and it's a kind of a winner-takes-all situation. So I suspect there'll be a lot of advertising push over the next quarter to get people in. So that's going to be positive pressure, I think, on Bitcoin now that the FTX money's all been liquidated. Then we've got the US elections coming up, so the US government are going to be putting pressure on the Fed to keep rates low. So that's helpful. At least it's not a headwind for Bitcoin. It's a helpful situation for Bitcoin. And then after the elections, I suspect the US is going to engage in economic warfare against the rest of the world, i.e. Russia and China, by allowing rates to spike up. And that's going to cause a massive bond sell-off, which will bankrupt China and cause a whole lot of other people to go bust. And then I think Bitcoin's in trouble. So I think probably I would be cautiously selling calls into the rally up till summer, and then preparing for a massive drawdown in the latter half of the year, which is contrary to everyone's expectations, right? Everyone thinks because of halving we'll go up, but I think as things look to me right now, I think gently up into summer and then carnage. So that would be, I'd be putting options on to take advantage of that.
And as we mentioned earlier too, we do like the idea of maybe taking a 1x2. So you think it's going to go up, you buy one call and you can sell two against it to pay for it. That way you're in the market, you'll take advantage of a gain up to a certain point. So at least you're in and it didn't cost you anything, or it didn't cost you much. Let's see here. Question from Sylvanus. This is 17% ROI for a few Bitcoins, right? Not for, say, a $1 million book.
You could probably do it on $1 million book. Yeah, you're not big enough for anyone to care about on $1 million book. On a $10 million book, and you start executing this through Paradigm, then you're going to be one of the people that they start mentioning. Yeah. But I don't think it matters, because the force of stupidity that drives Bitcoin is bigger than one $10 million book, right?
Force of stupidity. There's probably a technical term for the force of stupidity. If there isn't, we could make one.
Yeah. Moon fuel.
We're running out of time, though.
I think if you try at a 100 million book, then that's not so easy. Yeah. You probably want to spread those options across Deribit and CME and the upcoming options on the ETFs.
Yeah. Which the application has been put in for options on ETFs. So we'll see what happens with that and when those might come out. Look, we're 15 minutes past time, but hey, we want to try and make sure we always answer every question if we can. We've got two quick questions here. Dominic, what about buying straddles in a low IV market situation? Well, sure. That's sort of like the basic option 101, right? You don't know where it's going to go. You buy a straddle, but the problem is it's expensive. And again, anytime you're buying an option, you got to be right on timing and direction. So you can burn through a lot of money waiting for things to move enough for you to make that money back. That's why I prefer to do it the 1x2 or a long iron condor.
In Bitcoin, particularly, you can run out of money in like 2 weeks by buying straddles.
Yeah. So if you do it as an iron condor, a long iron condor, or if you're just doing 1x2s on each side, wonderful. That can be a great thing. Do you know how and at what times the spot ETFs get their Bitcoins? What's the mechanic about that? That's a very good question.
Quick answer. The sponsor gets the orders in at 8 a.m. Eastern time, and they get a price fixing from CF Markets, which is owned by Kraken. It's the only regulated index there is on Bitcoin, and they agree the orders in the early afternoon in the US. So you probably see volatility in the European morning, probably due to the grayscale sell-off and contagion from that. And you're seeing, I think in the afternoons, we tend to see a bit of a rally, don't we? As the ETFs come in and buy. So about 4 p.m. onwards, European time.
Yeah, and there's one other quick thing I'll mention too, and I forgot to mention the charts, is when I was selling puts on that down move, it felt that there is an invisible hand. I felt confident in selling those spreads because it felt like, this afternoon that invisible hand's going to come in and give me a little bit of assistance, and sure enough, it did.
I was short the puts at 40,500 into that. We dropped down to 38k, didn't we? Just about. And I just put on my diamond hands and sat there. I just knew it would come back.
Excellent.
I sold calls against it.
Please. Yeah. One last question, then we're going to take off here. A question from Sandro. I do understand that they work together with Coinbase, but I don't know much how it works behind the scenes. I see this follow up to the mechanics of when
they agree. They agree a fixing with the OTC desks, and the OTC desks will give them their Bitcoins at some price, and then the OTC desks will go and work that order in the market, which is why you see a whole bunch of volatility, because they're working it.
Mm-hmm. One last quick question here from Prince. Is it possible to extract data of closed options from Deribit API?
I was going to mention this earlier. One of the things I look at a lot on Deribit, and Deribit needs to do some work here on improving this presentation. I think you can get better information off Levitas. Let me just share the screen. Excuse me. Entire screen, that one. I spend a lot of time looking at this screen, working out where all the risk is. And the reason I care about this is that large concentrations of options risk represent either periods of calm if the dealer brokers are long options, or periods of volatility if the dealer brokers are short. The dealer brokers will be short if we've all been buying options. at a strike, and now the market's at that strike. The dealer brokers or market makers will be long if we've all been selling options at a strike, and so there's not quite enough information here to get an accurate picture. It'd be great if they could produce a 3D graph of strike versus date versus whether how much dealers are long and short, in terms of notional. Then you pretty much know exactly what the market was going to do, because we are now at the stage where Deribit and CME are pretty much in sync, and CME and Deribit between them probably actually dominate the spot prices anyway, in the way that all options markets do. So where we're looking at here, the majority of our stuff is expiring tomorrow morning, 94,000 contracts, and a good chunk of it's going to be at 50,000 calls. There's no way we're getting to 50,000, so we're not going to see any big moves. I don't think. I think that we got here. What's this strike here? 42,000, 40,000. So there's what, 14,000 contracts expiring. They're probably not all expiring tomorrow, but maybe, I don't know, maybe 5,000 of them are. So it'd be interesting to know whether the brokers are long or short. I suspect they're long, Gamma, because the market seems to be oscillating around 40k, right? So I think it's acting as a bit of a magnet. And I think we start moving away after tomorrow expiring.
Fantastic. Let's wrap it up. I do apologize for anyone who is on a tight schedule. We did go about 20 minutes over, but it was great that we could get all those questions in. Hey, if you like this, make sure you jump onto the YouTube, Deribit's YouTube, or our Rogue Trader Academy YouTube. Like, subscribe. And if you want to hang out and chat with us, check out roguetrader.academy. Other than that, get your questions ready. Good trading, and we will see you next Thursday. Hey, and thanks for watching this episode of Deribit Live. If you'd like to learn more, talk, and trade along with us, then check out roguetrader.academy, where we offer an incredibly unique educational and trading experience. There is no other service like this out there, period. Where else can you not only learn, but interact daily with professional, fun traders, with each of us having over 20 years of experience? And for those who just want to watch our daily live stream, you can do so via the links below. So if you want to peek behind the curtains and understand the strategies that we've developed since we started trading options in the 1990s and take your understanding and skills to the next level, then join now, and we'll see you on the inside.